Good morning, everyone, and thank you for joining us today. I'm Kathy from the Central Office, and I'll be your host for today's webinar, Where's the Money? Small Business Financing Sources. Your microphones and telephones are currently muted to eliminate background noise during the program. We will take questions at the end of the presentation. To ask a question, type it into the question box on your control panel, or if you have a working microphone, raise your hand by clicking on the hand icon and I'll unmute you. Today's program is being recorded and will be available through WebMQS in the Shared Resources section. I would like to thank Bill Grieshober from our Buffalo SBDC for arranging this presentation. So let's go ahead and get started. I'm very pleased to introduce Gerri Detweiler, Head of Market Education at NAV. Welcome, Gerri.
Thank you.
You're welcome.
Glad to be here. Shall I take over?
Take it away.
Okay, all right. Well, our presentation today is Where's the Money? Financing Sources for Small Business. And I know that some of you joining us are advisors that work with small business clients. Since we're recording this and it will be available to small business owners, I'm going to talk to you as if you're a small business owner, so hopefully you'll find that information helpful and worth sharing with your clients. So I've been involved in credit education for over 25 years. I wrote the first mass market book that talked about FICO scores back in the day. And my most recent book is Finance Your Own Business with small business attorney Garrett Sutton. And the reason we wrote that book is Garrett, working with small business clients around the country, he's actually part of Robert Kiyosaki's Rich Dad Advisors group. He found that a lot of small business owners were getting basically, getting sucked into expensive solutions to try to get financing that may not be best for them. So an example is he had a client who spent about $80,000 to buy a shelf corporation, a corporation that had already been formed, with the promise that it would get him like $1 million in instant lines of credit. And that client basically lost $80,000. So we want to provide basic information. In the course of researching that book, I came across a company called NAV, which is where I work full-time now. I liked what they were doing so much, I decided to join the company full-time. So there's a few resources up there. You're always welcome to email me with questions. The webinars at nav.com email will reach me directly, my Twitter handle, and the NAV Twitter handle as well. In addition, if you go to my Twitter profile, there is a link on there, a pinned tweet, that tells how to get my book for free. So that is something you can check out if you're interested in reading Finance Your Own Business. So I'd like to start with a poll and find a little bit about your experience with small business financing. So if you're an advisor, you could talk about this from the perspective of an advisor. How comfortable do you feel advising your clients? If you're a small business owner, you could talk about it from your perspective. But how confident do you feel searching for and applying for small business financing?
And everyone, you can go ahead and answer the poll, click on your answer. And I'll close in about 30 seconds. All right. And here are our results.
Okay, so we've got a pretty savvy audience here. Usually I find when I ask small business owners that question, we have quite a few that aren't very confident. I would like you to take a moment in the questions tab. This is a free-form answer, just to share sort of your number one question or frustration, or the number one question or frustration you think your clients see when it comes to small business financing. We won't address those all right now, but I hope by the end of the webinar, when we go to the question section, if there's any frustration that we haven't been able to address, at least in some way, that we can do that to make sure that this program is as relevant as possible to you. So you can use the questions button for that answer. All right, so generally financing for small businesses is a very frustrating process. The Federal Reserves do a study each year's Small Business Credit Survey. They look at small business owners' experience with getting financing. This statistic here, 72% of small business owners get turned down for loans, came from a study by the Federal Reserve Bank of New York in 2013. And the average small business owner, ends up spending a lot of time and spinning their wheels. One of the frustrating statistics I've seen is that about a fifth of them, 22%, have given up completely because they just don't think there's any way they can get approved. So we want to make sure that we help small business owners understand the options out there so they can, maybe they're not ready for financing now, but maximize the chances that they can get financing. At NAB, we've identified over 44 different types of financing. That's not products, that's not lenders, that's just types of financing. So you can imagine how overwhelming that can seem for someone who might be starting out and wondering what type of financing is best for them. And this is, I think, the most important principle that I can emphasize to you if you're looking for financing for your small business. And that is, there's almost always a trade-off between cost and effort. So the easier it is to get the financing, chances are the more expensive it will be. It's not always the case, but we find it pretty much plays out like this. And then the more effort you put into getting financing, the less you'll pay for it. So why this is important is because time and time again, we'll see small business owners who think, I don't really need financing, and then something happens. It could be a crisis or it could be an opportunity. They do need money, they need it quickly, and they haven't laid the groundwork, and so they end up in something that's very expensive and perhaps not sustainable for their business. So the goal is really to lay that groundwork early before you need the money tomorrow so that you're able to get more attractive financing terms when you need them. So we're going to do another poll real quick here, and we're going to talk about, I want to get your feeling about the cost of different types of financing that might be out there. So what I want you to do is rank these in terms of typical costs, least expensive to most expensive. So least expensive to most expensive.
So everyone, please go ahead and answer the poll.
And we will go over each of these types of financing in a moment. So if you aren't sure, you will get more information in a moment.
All right, give you just a little more time. Please answer the poll on the screen in front of you. All right. And here are the results.
Okay, yes. So typically your bank loan is the least expensive, followed by a microloan, then followed by a merchant cash advance. So this is a chart that just gives you an overview of some of the most popular types of financing with a few of the lenders that play in this space. But there are over 6,500 lenders competing for small business clients. So this is really just just a drop in the bucket when we talk about all the different types of financing that are available. So these are just a few examples of what the types of finance that we'll be talking about in a moment. So let's start out with bank loans. I find that when I talk to a small business owner, traditionally this is what they're thinking of when they think of small business financing. They want to go to their bank or credit union or community bank. They want to get a loan at good terms. And that's a great goal because these loans can be very attractive. But what we find is that a lot of banks, not all of them, but a lot of them are looking to make larger loans. They do have heavy regulatory costs. They have a lot of compliance costs. So they have a lot of fixed costs that go into just originating a loan, and so a small loan isn't necessarily very profitable for them. So a lot of times they're looking for a larger loan, and they do typically require the most heavy type of underwriting for the products that are out there. So there often is some work that's required to get one of these loans. Now, if you can, they're often very favorable, low interest rates, usually, very favorable payment terms, no big surprises. You may not have to worry about a prepayment penalty, or sometimes there will be a balloon, but usually it's built out in a few years so that the business owner is aware of it. They are harder to get. They're typically very hard for startups to get unless they have strong personal collateral maybe, and maybe a strong track record in that business. They usually aren't startup loans, and then they often require collateral and personal guarantees. So those are some of the drawbacks that small business owners may find if they're looking for a business loan. Now, among the types of bank loans that are available, the SBA loans are one of the most popular types. They're very popular. They're on fire nationally. We've seen record levels of SBA loans being originated, and the SBA does not make loans. They just guarantee them. So borrowers will go to a lender either in their area or perhaps across the country, depending on their needs and what that particular lender is offering. I think the biggest surprise for many small business owners is that they're not uniform. So a lender can choose what types of businesses they want to lend to. They choose their geographic area, of course. They will have their own criteria. So it's important for the business owner to understand that just because you can't get an SBA loan from one lender doesn't mean you can't get it from a different lender. Now, SBA loans in the 7A program for $350,000 or less do require a pre-screen using the FICO SBSS score. So this is a credit score that FICO develops specifically for small business. It's a commercial credit score. Like all FICO scores, FICO isn't a credit bureau, so they have to pull data from somewhere. So in this case, they will go to a commercial credit bureau and to a bureau that provides personal credit reports and pull that data to create this score. So it includes the personal credit of the business owner as well as the business credit of the business itself, and they combine that to make this score. Now the range is 0 to 300. 300 is the highest you can get. That's a low-risk score. And the SBA guidelines say that you need a 140 or above in order to pass the pre-screen. If you don't, it's kicked out to a manual review. Our experience at NAV is that most lenders are looking for 160 or above. And we have seen borrowers who don't have much business credit, but they have really strong personal credit, get a sufficient passing score for this, but it's a lot easier if the business has strong business credit and the owner has strong personal credit. That just makes it easier to achieve a passing score. So we'll talk a little bit more about credit in a moment, but I wanted to make you aware of that particular score. And currently the only place to get that score before you actually apply is through NAV. Now, term loans are similar to bank loans, but they come from non-bank lenders. So they might come from an alternative lender. It might be typically an online lender. It might be a lender who markets in a particular geographic area through direct mail and other types of sales. But they're going to be similar. They're going to usually have a fixed interest rate, fixed repayment period, and they often will want to see collateral. So a term loan, again, is similar to a bank loan, but it's not coming from a bank or credit union. They usually have decent rates, a little bit higher than bank loans, but decent rates and fixed terms. But they usually do check credit. They will often check the business owner's personal credit, and they may check business credit as well. They may require a personal guarantee. And one thing we found is sometimes it can be tricky to understand whether you're really getting a business loan or a personal loan. So sometimes they market it as a business loan, but they're really just looking at the business owner's personal credit and personal qualifications, and then they will report that loan to the personal credit bureau. So it's really essentially a personal loan that you use for your business, as opposed to a business loan that's made on the strength of the business and is reported to the business credit bureaus as opposed to the personal credit bureaus. So you kind of have to be a little bit careful if that's an issue for you or your borrower. To be careful to understand, and a lot of times you can just see how much personal information they're asking for, or you can even ask the lender, is this really a business loan or is this a personal loan that I can use for business? That might be helpful to understand that particular option. Receivables financing. Now this type of financing is popular for a business that has invoices that get paid later. So earlier in my career I did a lot of consulting for some very large financial institutions, and my experience was typically the bigger the client, the longer they took to pay. So literally sometimes it could take 3, 4, or 5 months to get paid by a client. And if you don't have sufficient cash flow to meet payroll, to meet your expenses, to pay yourself as a business owner, this might be a way to get some of that money more quickly so that you can meet your expenses and still pay your bills. Now, what happens here is the company that is extending the credit up front typically will advance part of the invoice up front and then will pay the rest minus their cost or their fee when the invoice is paid by the client. They can do it on a variety of different ways, but the interest rate we usually find out works out to somewhere between the 15 to 35% range. Not always, and it can be a little bit tricky to understand the cost, especially to understand it in a in terms of an annual percentage rate, which is what we're used to using to compare costs of loans. We'll talk about how tools for doing that in a little bit, but you just have to understand that the cost can be a little bit hard to decipher sometimes. Now, what they're really looking at here is they're looking at the credit of the client that owes money, because that's who's going to have to pay. So they may be interested or not interested at all, or a little bit interested in the credit of the business owner themselves. That may not even be a factor if you have a really strong client that owes money, a Fortune 500 company, for example. And they can do it on a recourse or non-recourse basis. So that means that if on a non-recourse basis, if the client never pays, the business owner gets to keep what they have. If the client does not pay, then the business owner would be on the hook and have to repay part of all of that money. So this solution, because of the cost, is not ideal for a long-term solution. Obviously, a long-term solution might be better in terms of a bank loan or a line of credit that's more predictable and lower cost, but it could be a good short-term solution, especially for a business that does have a lot of outstanding invoices. I want to share a quick story. This is from a business owner that I interviewed and wrote about on the NAV blog, Dave Edmondson. His company, Salt and Savor, he started making sauerkraut in his kitchen, and everyone loved his sauerkraut, said, you should sell this, and he kind of rolled his eyes, so you're all right, everyone says that. But after he got enough compliments like that, he decided to take it to a local farmer's market. So he did, and he sold out. And not only did he sell out, but he had customers wanting more. So he said, maybe I'm onto something. So he started selling more sauerkraut. Well, he quickly realized that he needed some money to finance more equipment for his production. So first he turned to credit cards. So he maxed out all his personal credit cards. And then he needed more funding, but he was having trouble getting funding because his credit cards were all maxed out, and that hurt his credit score. So he ended up turning to a lender called Kiva, kiva.org. Kiva is a microlender, and they use a hybrid blend of microlending plus crowdfunding. And they charge 0% interest, because the lenders who lend money on this platform are doing it for philanthropic purposes, trying to help support small businesses. So he went on this site, and because with Kiva, you have to have backers initially. You either have to have a trustee who vouches for you, you have to have a few backers. Because he had this community of people who loved his sauerkraut, he had a Facebook page. He went on the Facebook page, told everyone about it. He immediately got his backers, and then when Kiva released his campaign to the Kiva website, he sold out very quickly. So he raised the funds he needed very quickly. And he started to grow his business. Then he needed to go into a neighboring county, which required an expensive food license. He's in Northern California. So he needed more equipment. So he went back to Kiva for a second loan. And then the second time he did it, a health food store said, if you will put your product in our stores, we will fund your campaign. And he agreed right away. And now he's in health food stores, and his business is growing. So I give this example because a few years ago, I remember getting an email from a woman who wanted to start a janitorial service, and she just needed a few $1,000s to get started, but she didn't have friends and family who could help her. Her credit was horrible, and I didn't really have a good solution for her. Now I feel like there's so many intriguing new business models that are coming out in terms of the small business lending market, that there are more opportunities than ever to start a business and to get funding. So we're going to talk about some of these options as we move on, but I want to provide Dave's story as sort of a hopeful story for the types of programs that may be available. So microloans are small loans. $100,000 may seem like a lot to some small business owners. It might not seem like a lot to others. It may not seem like much at all to a bank who's looking to make larger loans. But sometimes this is all the business needs to get to the next step. So like Dave's story, they might just need that small capital infusion to grow their business to the next step. So microloans can be very attractive. The interest rates aren't quite as low usually as bank loans. Not always, like the Kiva example is 0%. You can't beat that. But a lot of times they're a little bit higher, but they're often very flexible. They may be willing to overlook credit hiccups in the past, especially if there's a good explanation. They're often looking to serve underserved communities, whether it's immigrants or women or small business owners who don't have access to traditional capital in their community. And they often come with something called technical assistance, which could be everything from mentoring to networking help to help with your bookkeeping, just to help the business succeed. So that's often part of the equation as well. The loan amounts, again, tend to be small, and they can be a little bit hard to find for a small business owner. So what I often tell small business owners, if you're looking for a microloan, there are several directories online. The Opportunity Fund, for example, has a directory of CDFI lenders and microloans, and your local SBDC often knows what is available in your community. So talking to your SBDC can be a great way to find out what microloan programs or small business grants may be available in your community. Business cash advances. So these are very, very popular. This is the fast funding. This is when we remember that chart where we had cost versus effort. This is the high cost offer, but low effort. So what the company will do, they technically don't call themselves lenders or that they're making a loan, but they're advancing funds. But it feels like a loan to the small business owner. It has to be paid back. So what they do is they look at the credit card statements or the PayPal account or Square account receipts of the business. And so this is popular with something like restaurants, dentists, day spas, somewhere that's accepting a lot of credit card transactions. And they will then advance money based on the past sales for the future. Then they take out the payment, usually on a daily basis. A few of them will do it weekly, but usually on a daily basis, they start taking out a portion of the sales in order to get repaid for that cash advance. As you see there, the effective interest rate is often very expensive. These are often the highest cost type of loan. It's almost the equivalent of, say, a personal payday loan. But as we know from the consumer world, payday loans, and the business world, business cash advances, sometimes you have to do what you have to do. And sometimes it can pay off if the opportunity is strong enough to warrant that kind of cost. But business owners don't always understand what they're getting into. So most of these companies aren't interested in credit. They're really interested in the receipts, sales receipts. And again, they're very expensive and they can have a daily, weekly payment. And they often will have a prepayment penalty. It's not technically a prepayment penalty built in, but you agree to pay back a certain amount. So if you pay it back faster, you still are going to pay back that total amount, even if you pay it back earlier. Now, a couple of competitors have come into this market recently: Square, PayPal Capital, and for merchants, for Amazon merchants, Amazon also offers this type of financing. And what they do is they analyze their customers' receipts, and they will proactively reach out and offer financing. Because they don't have to pay someone to market the financing solution, this is often cheaper than your traditional merchant cash advance, where someone's going to sell you that product, or it might come through your company that you use for your credit card processing. Square, for example, their APR works out to be 24%. So not the cheapest source of funding, but also not as expensive as 70 or 100%. So that may be another solution for a business owner who does accept payments through one of these methods to consider. Cash flow loans, these are very similar. They're going to look at the cash flow into the business's bank account. So they're going to look at the deposits and withdrawals coming in out of the business bank account. They may want to see the number of deposits. They may want to see the amount of the deposits, the frequency. They may want to look at how many different deposits there are in terms of whether there's a broad client base. Because if there's one client, that could be a high risk factor. For one or two clients, that could be a high risk factor for the business. But they're going to analyze the cash flow, and they're going to do it in a couple of different ways. One is they may ask for bank statements. The other is they may ask to actually link to the business's bank account or the business's QuickBook accounts. So they can look at QuickBooks or look at the bank account to analyze what's going in and out of the account. Then they will base their decision based on the cash flow of the business. So again, these are very fast. We usually see a minimum credit score requirement, but it's pretty lenient. So it's usually in the mid to low 600s. Might even dip down to the 500s depending on the lender. It'd be expensive, and again, prepayment penalties. You agree to borrow a certain amount, pay it off faster, and you still will pay off that total amount regardless of how quickly you pay it off. All right. So let me ask a question here. We're going to use the open-ended question panels for this. I'm looking for the different types of crowdfunding that are available to small business. So we're looking at types, not necessarily specific companies that do crowdfunding. So not necessarily Kickstarter or Indiegogo, but the different types of crowdfunding that are available. So let's see what answers you might have here.
Okay, everybody, we're looking for a response from you, so please use the question pane on your control panel. And I'm going to assume that nobody is answering. Oh, Kate, you've got your hand raised. Could you please type your question into the control panel?
And if not, I'll tell you.
Yeah, I guess nobody knows.
Okay, all right, well, good. Well, then we'll explain it. All right, rewards, debt, donation, and equity crowdfunding. These are the four main types that may be available in small business. So reward crowdfunding, that's the one that's the most popular. The Kickstarter platform is the great example of that, where, you know, a musician decides to cut a new album and they will give tracks before everybody else, or a concert, or whatever it is if you donate, or a t-shirt, or whatever it may be. Debt crowdfunding is actually loans that are crowdsourced. This big example, Lending Club and Prosper, which, you know, when they first started out, it was literally individuals investing in other individuals. Now it's become a lot of institutional money, but it's still a crowdfunding platform. Donation crowdfunding, not so popular with small business, but it does happen. So for example, after Hurricane Sandy, I think there were some businesses that were able to rebuild thanks to donations from loyal customers. So donation crowdfunding would be where you donate to a particular cause or an effort. And then equity crowdfunding, which we'll talk about in a moment, a newer type of crowdfunding made available more recently through legislation. All right, so the benefits of crowdfunding is usually very good terms, so very attractive in terms of the costs that you'll pay. You'll pay the fees to the crowdfunding platform, but usually quite attractive. And they usually don't look at credit. So it's very rare for them to have any kind of credit requirement whatsoever. I mean, Kiva's example, I think you can't be in an open bankruptcy, but other than that, everything else is fair game as far as credit goes. But they are high effort. You have to be able to tell a really good story. So Dave's example with his sauerkraut business was a little bit of an anomaly because he crowdfunded his campaign very quickly. I think it was within 24 hours. But that's not typical. So most small businesses, it's going to take a while to raise money. Crowdfunding is a high effort endeavor. And it very likely, if crowdfunding is something that you're interested in, your SBDC very likely will be able to help you with some resources that can help you understand the crowdfunding process and how to put together a good crowdfunding campaign that's likely to be successful. So again, we mentioned reward crowdfunding. This is where you might, maybe you're launching a product and you'll offer a beta version of the product, or the first version of the product will go to the people who back your campaign. I recently spoke to an entrepreneur who does a lot of crowdfunding, and he said, I don't need the money anymore. He said, I don't do it for the money. He said, I do it because I want to test my product. And he says, I know that if I run a good campaign and there are not enough backers, I shouldn't waste my time and energy trying to create that product, because it just isn't going to fly. So this is an interesting take on crowdfunding, that it could be a way to test the waters before you invest years or thousands of dollars in a product that may not take off. Equity crowdfunding was made possible a few years ago thanks to the Jobs Act, which is a law that allows for more broader access to capital from small businesses. With this, there are very specific requirements. You have to go through an SEC-approved portal, but what you're basically doing is raising money from investors all over the country or the world, and through the platform. So some of them will only still work with accredited investors, which are wealthy individuals. Some of them open the campaigns to other investors as well. There are limits under federal law, but it's the platform's job really to vet for that scenario. And then again, you're raising money from investors all over. And pros or cons, it's not a super popular way. Let me go back because I jumped on that. It's not a super popular way to raise money yet, but it is working for certain types of businesses, particularly biotech or technology companies, or companies where the founder has a really good track record and people are just eager to place their bet on their next project, on the founder's next project. But you will have investors who may not be sophisticated, who may not really be as anxious to wait out your progress as they thought they were when they signed up. And so it is something that you really have to go in with your eyes wide open. All right, we're going to shift gears and talk about credit cards for a moment. And so I do have a poll here, and this is important because this is a topic I find that many small business owners really don't know much about. So what I'm looking here, and this is a choose all that apply answer. So hopefully if we set our poll up correctly, it will let you choose more than one answer. But the federal law usually protects cardholders if their cards are lost or stolen on which types of plastic? Choose all that apply.
Okay, folks, please respond to the poll. All right, everyone, click on the answer on your screen, please. All right, I'm closing the poll in 10 seconds. And here are our results.
Okay, good. All right, good. So let me go over this because I think this is an important issue. Federal law protects business credit cards, personal credit cards, and personal debit cards. The protections are strongest in the case of credit cards. They're stepped up in the case of debit cards. So the credit cards is $50 max liability for fraudulent use, and most issuers won't charge you for that. Personal debit cards, it starts at $50 and goes up from there. It can go to your entire account if you don't catch it. Rare for that to happen, but I remember a situation where an elderly woman had a caregiver who was using her debit card without anybody's permission, and the family didn't find out for a few months, and she literally wiped out her entire account. So that is possible, but business debit cards are not protected by federal law. Business debit cards are not protected by federal law. Now, most issuers, if you have a Visa or MasterCard logo, are going to apply zero liability. That is a voluntary process, and it can take a while to get the money back in your account. In the meantime, you have bills to pay, and that can be a very scary experience. I was in a seminar at an SBDC, and a business owner said to me, yeah, he said, I was standing in the lobby of my bank. My business debit card was compromised. I was standing in the lobby of the bank on the app watching the money drain out of my account. He said it was the most surreal and scary experience I've ever experienced. So I want business owners to understand the pros and the cons. If a business owner is nervous about using their using a credit card because they're afraid they're going to run up debt, then consider a charge card. A charge card requires you pay it in full each month, but it is covered by federal law the same way a credit card is. So the liability is zero in the case of fraudulent use. Now, credit cards are a very popular way to fund businesses, very, very commonly used. They're very flexible, so if you need money, you don't have to apply to anybody. You don't have to say why you need the funds. You just use your credit card. The average interest rate on a business credit card these days is 15%. So it's not the cheapest money, but as we've seen from some of the other examples, it's not the most expensive way to borrow either. Great rewards, especially on business credit cards. The credit card issuers really want business customers, and so a lot of times they'll entice them with very solid rewards, sometimes bonus sign-up points, etc. So that can be very attractive. Great fraud protection, as I mentioned. They do help build business credit. So most business credit cards are reported to business credit bureaus, so they help build a business credit rating. And then they can also be helpful at tax time. If you put all your purchases on a business credit card, as opposed to if you on a personal credit card, if you on a personal debit card, if you pay this way or that way, it's a lot easier to work with your accountant at tax time or get that into your account. Now, one thing I do want to point out is that most business credit cards do not report to the owner's personal credit unless they default. So remember our sauerkraut king, Dave Edmondson, he said he put most of his early expenses on his personal credit cards. That maxed them out and that lowered his credit score. He paid on time, but his credit score was hurt by that activity. So with a business credit card, if it doesn't report to personal, then it won't bring down the credit score. And so that may be another benefit to using a business debit card or business credit card to separate out the business purchases and also protect the owner's personal credit. You see a short URL there that goes to an article I wrote, and if you scroll down that article on the NAV blog, you will see a chart, and it outlines how each of the major business credit card issuers reports. So that will give you some resources there to help you understand that issue. Another popular way to use credit cards among some small businesses is what's called credit card stacking. And this is where someone will get multiple cards and use this to fund their business because they can't get traditional financing. It's very popular among real estate investors who often find traditional financing very difficult to get unless they go for hard money, which is often very expensive. So we see a lot of real estate investors who flip properties use this method. They'll max out the credit cards, they'll fix up the property, sell it, and then they'll pay it off. Works well if you make a profit, not so well if you end up, in a money pit or in an economic downturn as we did in 2008 where you get stuck, holding all that credit card debt. So it has to be done very carefully. We also want to avoid hurting the credit score too much with this approach. So I just recommend that business owners who are thinking about this, make sure they get some good advice so they don't end up accidentally damaging their credit or getting into an unsustainable financing situation. All right, I'm going to wrap up with a couple different types of financing. We're going to give you a few tips for qualifying and for getting prepared. So trade credit is the single biggest type of financing among businesses. This is where the business will get something on terms. So it might be the plastic they need or the, the materials they need to make their product. And they get it and they pay for it later. So it might be net 30 terms, due in 30 days, net 60, due in 60 days, etc. This is often very attractive. Sometimes they don't charge interest at all. Sometimes they do, but sometimes they don't. And it can literally mean the difference between making payroll or not. If you can get the supplies you need, make the product, sell it, and get the money in the bank, then you don't have to turn to a traditional lender for that financing. Startups, oh, by the way, on trade credit, they usually do look at business credit. So most vendors and suppliers do want to check at least like a Dun & Bradstreet, D&B, Paydex score, or an Experian credit report, etc. Now, I often get asked what type of financing is available for my startup. We've gone through most of these here, so I'm not going to go into detail, but these are some options that may be available to startups. And the most recent small business credit survey that came out from the Federal Reserve Banks does show that friends, family, and personal resources are the #1 form of financing for most businesses when they're just starting out. I also get asked what types of credit are available if I don't have good credit scores. And they're very similar to the startup financing, but you see some of the types of credit that might be available to someone who has some credit challenges. So those are some options. And I'm always happy to share these slides. So if you would like the slides after the presentation, or if you're watching the recording, you can always email me at webinars@nav.com. I'm happy to share them. All right, so we have, let's see, we have a few minutes left, so let's go through some ways to get lender and credit ready and then answer some questions. So at NAV, we did a survey a couple years ago nationwide of small business owners, and we discovered an interesting finding that small business owners who understand their business credit are 41% more likely to be approved for a business loan. So we think that's a competitive advantage, and that's one of our goals at NAV, is to help borrowers be ready. So the SBA and your SBDC do not endorse individual products or services. So I work for NAV. I'm going to tell you briefly what NAV does, but this is not an endorsement. It certainly is not something you have to do before you get help from your SBA, SBDC, or a SCORE mentor, for example. But if you are interested in learning about business and personal credit, NAV is the only source that will show you free business credit scores and personal in one place combined. So this is a free service. You don't need a credit card to sign up, and each month you'll get an updated Experian IntelliScore, which is their commercial score, Dun & Bradstreet Paydex, which is their main business score, and then a personal credit score from one of the major credit bureaus so you can understand where you stand. We think it's really important for business owners to understand their credit before they start applying, and a lot of times they don't. And it's just common. We're all busy, and we just don't get around to it, so we do recommend you check before you apply. And we also recommend that business owners who are thinking about getting financing have a business plan. As you saw in the slides before, not all lenders are going to look at a business plan. We do find they're more traditionally required by your lenders, like your bank loans or traditional loans, maybe a microloan. They might want to see a business plan, but the things that you do to create a business plan will provide you with intelligence that will make it easier for you when you go to apply. And you'll see that in just a moment when I talk about some of the numbers. So your SBDC actually can help you. This is a resource that is on their website, and they can help you apply for or help you create your business plan. You can get a counseling session with them to help go through your business plan. There might be market research available to help you plug in the numbers. That's one of the big hurdles for many small business owners, where they say, well, I don't know how to do projections. I don't know what my market size is. Well, contact your SBDC, because they are going to be able to help you get off on the right foot there. Now, we do recommend that small business owners know their numbers before they start to apply, because some lenders are going to want to know some financial information from the client. Not all of them are just going to plug into the bank account or just look at the credit card sales. So you really do want to have a good, solid accounting relationship. You want your books to be up to date, and you want to be able to produce this kind of information if a lender asks for it. If you have this at your fingertips, then when you go to a loan application that asks for it, you can just apply it. It doesn't stop you in your tracks, and you get busy, you start working on something else, and then you never go back to it. I'll know how that happens in business. So you want to be prepared as possible. And again, your accountant can help you prepare this, and you can also work with your SBDC to lay the groundwork for financing, because they're very knowledgeable about financing sources. Now, this is a list of minimum lender requirements that we suggest to our customers, because a lot of the people that come to us at NAB are in the early stage of their business. Not all of them. We certainly have businesses that have been around for 10 years or more, but we do get startups who are asking for, what do I need to do to apply? So we tell them, here's where you should be before you really start thinking about getting business financing. You really need a business entity. As a sole proprietor, you can still build business credit, but it's harder, and you really are the business. I mean, there's no distinction. So if you want to get a business loan, you need a business. So that means setting up the proper business entity. Most lenders are going to want, if they look at personal credit, they're not going to want to see too many inquiries into personal credit. So generally we say 5 or fewer in the last 6 months. That's per credit bureau. Having your debt ratio or your credit utilization under 30%. So remember, we talked earlier about how having a lot of personal credit card debt for your business can bring down your credit scores. Lenders will look at the credit limit, they'll compare it to the balance, and if it's too high, you get dinged essentially for that. So they want to see that the personal credit score that these personal credit cards aren't maxed out. That will definitely be a factor that could affect the credit score, as well as affect the ability to get the loan. And then they generally want to see a business or a personal credit limits combined of at least $5,000. Not always. Some of them go as low as $1,000, but someone who doesn't have any credit cards is going to find that to be a little bit of a hurdle. And then open and use your business bank account. Niantic actually did a survey last year, and they found about 1 in 5 small business owners don't even have a business bank account. You need a business bank account if you want to start establishing business credit and getting business loans. And then this is another checklist that we say, if you have this information handy in a file or in your Dropbox or Evernote folder or somewhere that you can provide to a lender, you would have what most lenders would want to see before you apply. So this is the checklist that we often recommend to business owners to have handy so that they're ready to apply for most types of financing that they're looking at. And again, if you need the slides, just email me at webinars.com. Now, one thing we do at NAB is we do help match borrowers to financing. So if they are looking for a business credit card, for example, in our business marketplace, what we do is we have an algorithm called Match Factor. We know the business and personal credit, and we know what lenders are looking for, and so we'll actually rank these and give a score. So we'll predict how likely the business owner is to qualify for that particular credit card, for example, so that they hopefully will spend less time shopping around and wasting time and getting denied for credit cards that they really wouldn't qualify for in the first place. So Match Factor is a tool. I talked about the cost of financing earlier. The challenge is that it's very, very difficult to understand the cost of business financing. There was a story in the news recently. A hair salon owner went to get financing, and she was quoted a stated rate of 15%. Now, a stated rate is not something that we're familiar with in consumer lending. In consumer lending, everything's APR, right? Annual percentage rate. So it said stated rate of 15%. Well, she ended up going through a calculator and discovering that the interest rate was over a 4,000% APR. So from 15% to 4,000% APR. She ended up getting better financing through Able Lending, which is sort of they're also a combination of a traditional lender with a crowdfunding aspect to it. And the lesson is that the borrower has to understand their costs they're getting into, but it's very confusing. So these calculators are available on the NAV website. So if you just go to nav.com at the top, you see resources, you can click down there. They don't require any personal information, and those are a resource that you are welcome to use if you're working with a client, or if you are a small business owner, you're trying to understand the cost of the financing you're getting into, to help you compare it to an APR so that you see the cost that you're used to seeing as opposed to something that might just not be familiar. In addition, we have a free ebook called nav.com/ebook. And this ebook reviews a lot of lenders. So it covers everything I've talked about today, but we also reviewed a lot of lenders. So this will go into detail about specific individual lenders that are popular in the different spaces and help you understand whether those might be appropriate for you. Now, if you are an SBDC advisor, we also make this available through our free advisor program, just nav.com/advisors. And you will be able to download the ebook from the advisor program directly there. This is a download for the small business owner directly. All right, so we're going to wrap up here in a moment. I'll take a few questions here while you're thinking of your questions. So a lot of times a small business owner will get into a cash crunch, or they'll want to grow their business and they'll think, well, my only option is a loan. But sometimes there are other options that might be available. I just recently wrote an article for allbusiness.com on 23 different alternatives to a loan to boost your bank account. So I just want to get your ideas for a few that might be available to your clients if they are in a cash crunch and they can't get financing right away. So you can use the questions tab for this.
Hey, Beth, you have your hand raised. Oh, she's typed in her question. What is the address to receive the advisor ebook?
Oh, okay. It's just nav.com/advisors.
And everybody, we are looking for an answer to the question that is on the screen before you. So please, if you have an answer, type it in.
So if you have a business owner who comes in and says, I can't get a loan, but I need to improve my cash flow, what might be some ideas? Let me go ahead and suggest a few, and you might think of some too. So certainly increasing sales, whether it's running a sale, offering a discount, pre-selling something, bundling a product, those might be ways to get, collecting money owed. NAV's founder, Levi King, started his first business in his early 20s. He started a sign manufacturing company in rural Idaho. And he says there were days where he would, on a Thursday, have to put on his best suit, get in his beat up car and drive around and beg his clients to pay him what they owed him because he needed to make payroll the next day. And then he'd run to the bank and beg the bank to clear the check right away so he could pay his employees. So sometimes collection is a real issue. And we know from many statistics that many small business owners are sitting on money that they are owed but are not collecting either. It's taking a long time, or they'll never get paid because the client may never pay them. So that's something to consider. Could you pre-sell a product? Could you reduce your expenses or get terms with your vendors or suppliers? So Levi also said that in that first sign business, he wasn't using credit at all. He didn't really know about credit. He was raised to avoid debt. So one of the steps that helped him was getting terms from his plastic supplier and his steel supplier so that he could get the materials he needed, build the sign, install the sign, get paid for the sign, and then pay back those vendors. It was a way to keep his cash flow going. So those are some other options. And again, I just wrote an article on 23 ways to do this. It's allbusiness.com, or you can email me at webinars@nav.com, and I'm happy to send it to you. All right, so I hope you found some helpful information here, an overview of the options that may be available to small business owners who are looking for financing. Happy to help. Again, NAV is here to try to help reduce the death rate of small businesses. That's our mission, and I know you're at the SBDC and the SBA. The mission is to help businesses grow, and the statistics back it up. Small business owners who work with an SBDC are likely to grow faster and be more successful than businesses that don't. So if you're a small business owner who's watching this presentation, do not hesitate to make an appointment to visit your SBDC, to sit down with a counselor for free, or to take another training program at your SBDC, because you're going to find it's a smart investment in your business. And if you're an advisor, please feel free to sign up for the nav.com/advisors for our free advisor program. We'll give you tools, resources, and additional training to help your small business clients. All right, thank you. I'm happy to take any questions.
Thank you so much, Gerri. Does anybody have any questions that you can think of at this point? Here's a great question. Do you offer this presentation in Spanish?
No, I don't yet, but I wish I spoke Spanish so I could do that. But it is on my list as head of market education for NAV. Probably not this year, but hopefully in the future.
Any other questions? If you do think of any after the fact, of course, you can go ahead and contact Gerri directly. And please, when we're done, do fill out the survey at the end of the webinar. So we will go ahead and end. Thank you so much for presenting today, Gerri, and thank you everybody for joining us. And this concludes our webinar.